Welcome to the Deep Dive, where we take those dense financial reports and turn them into the key insights you actually need.
Yeah, digging through the details so you don't have to.
Exactly. And today we are unpacking the latest results from Fast Retailing Co. Ltd. That's the parent company of UNIQLO GU and their global brands portfolio.
We're looking at their fiscal year 2025, the one that just wrapped up August 31st, 2025. And, well, the headline you just have to start with is another record year.
Another one. That makes it 4 years straight.
4 years running, which, in this global retail climate, that's saying something that hasn't exactly been smooth sailing out there.
No kidding. 4 years suggests more than just luck, right? Real strategic momentum. So let's get those big top-line numbers out first.
Okay. Consolidated revenue. They broke 3.4 trillion yen, came in at 3.4005 trillion. That's up 9.6% from the year before.
Almost 10% growth on that massive base. Impressive.
Right.
What about profit?
That's maybe even more interesting.
Yeah.
Business profit grew faster than revenue, hit 551.1 billion yen, which is up 13.6%.
Okay, revenue up 9.6%, profit up 13.6%. That widening margin, that's what we need to dig into.
Precisely. Our mission for this deep dive is figuring out why that happened, where did the growth really come from, which parts of the business fired on all cylinders, and where were the unexpected bumps in the road hiding under those record numbers.
All right, let's start breaking it down. Foundation first. UNIQLO Japan, the home market, sometimes seen as maybe a bit mature, a bit steady, but it sounds like it really performed this year.
Oh, it absolutely did. UNIQLO Japan finally crossed a huge milestone. They topped 1 trillion yen in revenue just domestically.
1 trillion, just in Japan.
Just Japan, 1.0260 trillion yen to be exact. That's a 10.1% jump. Pretty remarkable for what many considered a saturated market.
All right, double-digit growth in a mature market. How? What was the lever they pulled? Was it just getting lucky with the weather or something more deliberate?
Definitely strategy. The report points to two key things. First, they were apparently really smart about matching inventory to, the actual temperatures people were experiencing.
Yeah.
Getting the right stuff out at the right time.
Seems basic, but hard to execute at scale, I guess.
Right. And second, they weren't just selling the same old stuff. They actively created new demand by taking current fashion trends, like certain silhouettes, and building them into their core items. They specifically called out sweatshirts and jeans doing really well because of this.
Ah, so updating the classics. That makes sense.
And it worked. Same-store sales for the full year were up 8.1%.
And usually when sales are that strong, especially same-store sales, it means things are running smoother behind the scenes too, right? Costs.
Absolutely. That's the efficiency point. The strong sales directly led to a better cost structure. They improved their selling, general, and administrative expense ratio, the SG&A ratio, by 1.2 points.
Hold on. Let's just quickly clarify SG&A for everyone. That's not the cost of making the clothes, but everything else. Rent, salaries, marketing.
Exactly. All the overhead.
Yeah.
Running the stores, running the head office, advertising, all that jazz. So when your sales grow faster than those costs, your SG&A ratio gets better.
And 1.2 points improvement. That might not sound like a lot, but on a trillion yen base.
It's huge. It drops straight to the bottom line. That efficiency gain in Japan was a really significant piece of the overall profit story for the whole company.
Okay, so Japan was strong and efficient. Let's pivot to the real growth engine, right? UNIQLO International.
Yeah, this is where the massive scale comes in. Another record here, too. UNIQLO International revenue hit 1.9102 trillion yen.
Wow, almost double Japan's revenue.
Yep, that's up 11.6%. And business profit there grew to 305.3 billion yen, up 10.6%. The core message is pretty clear. Their whole lifewear concept is gaining traction globally, and is being helped by opening really high-quality stores in key locations.
Okay, but global is a big place. The success wasn't even everywhere internationally, was it? This is where we see that big geographical shift you mentioned earlier.
Exactly. This is maybe the story of FY2025 for fast retailing. Forget uniform growth. Think targeted explosions. We need to talk about North America and Europe.
The breakout stars.
Absolutely. North America.
Yeah.
Revenue shot up 24.5%. Business profit, even better, up 35.1%.
Whoa, okay. And Europe.
Similar story, maybe more dramatic on the top line. Revenue in Europe was up a massive 33.6%. Profit there grew 23.7%.
That's incredible growth in really tough competitive markets. What was the mechanism? How did they pull that off? The report mentioned something about the stores.
Yes, this is super important. They said their newly opened stores were extremely successful, but not just as places to sell clothes.
How so?
They describe them as media beacons.
Hmm.
Think flagships in major cities. They generate buzz, they raise brand awareness way beyond just the people walking in.
Ah, like a giant advertisement that also happens to sell things.
Kind of. And that buzz creates this virtuous cycle. It drives traffic not just to that store, but boosts online sales across the region too. People see the brand, hear about it, then maybe buy online later.
Interesting. But is that sustainable? Flagship stores and prime spots are insanely expensive. Can that media beacon effect pay off long term?
Well, that's the million-dollar question, isn't it? Or maybe $1 billion in their case. Right now, the profitability suggests it is working. They're still in that phase of really establishing the brand in these markets.
So the initial investment in brand equity is paying off for now.
Seems like it. The buzz is translating into loyal customers who buy across different channels, online and offline.
And that brand strength got tested, didn't it, in the U.S.? The report mentioned tariffs.
Yes, a really fascinating stress test. The U.S. government imposed some additional tariffs. You'd expect that to slam profits, right?
Absolutely. Higher import costs usually mean lower margins or slower sales if they raise prices too much.
But in the fourth quarter, North America still saw significant increases in both revenue and profit, despite the tariffs.
Did they just eat the cost?
No, this shows real pricing power. They didn't just absorb it. They managed it actively. They reviewed prices, meaning they raised some. They cut back on discounts, selling more at full price. And they tightened up costs elsewhere.
So consumers were willing to pay a bit more.
Apparently so. The brand value was strong enough that they could pass on some or maybe even all of that tariff cost without killing demand. That kind of discipline, that's what turns a good year into a record breaker.
That really highlights the power of brand. Okay, let's flip the coin. The counterpoint to this Western expansion success, Greater China. Mainland China, Hong Kong, Taiwan. Historically, they're a powerhouse.
Yeah, historically. But this year, it was a major drag. Full-year revenue there actually declined 4.0%.
Declined? Wow. And profit?
Took a much bigger hit, down 12.5% for the full year. This is the headwind that the growth in North America and Europe had to overcome.
A 12.5% profit drop in Greater China. That must have caused some serious concern internally. What went wrong? Was it just the economy there?
It was a mix, according to the report. Partly external, yes. A generally depressed consumer appetite for clothes in the region, but also internal factors.
Like what?
They specifically mentioned an insufficient product mix. Seems they didn't quite nail the product assortment, especially with some unusual weather patterns, like warm spells during winter. They couldn't react fast enough.
Ah, so it wasn't just shoppers not buying, it was also fast retailing not having the right things for shoppers to buy given the conditions. A failure of agility.
Exactly. It exposes a potential vulnerability, maybe in their planning or supply chain responsiveness for that specific region, something they need to fix.
Is there any sign of a turnaround there?
There's a glimmer. They did note that sales picked up a bit towards the very end of the fiscal year, in August and into September. And Q4 profit in mainland China actually rose about 11% year-on-year, mainly due to better margins right at the end.
Okay, so maybe stabilizing. But the big picture for FY 2025 is clear.
Absolutely. The massive growth spurt in North America and Europe effectively bailed out the overall results, offsetting that significant weakness in Greater China. A real geographical pivot in earnings power.
Right. Let's shift gears now to the other parts of the business, the smaller segments. Starting with GU, this one looked confusing.
Yeah, GU is supposed to be the faster fashion, trendier sibling to UNIQLO, and the results were paradoxical.
How so?
Well, revenue was up, not hugely, but up 3.6% to 330.7 billion yen. Looks okay on the surface, but profit went the other way, and sharply. It contracted 12.6%.
Ouch. Revenue up slightly, profit down significantly. That screams trouble. What happened?
Two main things, and they're linked. First, an operational miss. GU lives and dies by catching mass fashion trends quickly. The report says they failed to produce enough hit products.
They missed the trends.
Seems like it. Or didn't have enough stock of the things that were hits.
Yeah.
So if you miss the trend, what happens? You end up discounting heavily later to clear out the old stuff. Kills your margins.
So UNIQLO's strength was adapting core items, while GU's weakness was failing to capture fleeting trends. The tortoise and the hare, almost.
That's a pretty good way to put it. And the hare stumbled. The second hit was on the cost side.
Ah, the SG&A again.
Yep. The SG&A ratio at GU got worse, partly because of rising wages, necessary investment, probably, but also because of the costs of opening their first GU store in the United States.
So they added expansion costs right when their core operation wasn't generating enough high-margin sales to cover it.
Exactly. Bad timing. The strategic push into a new market amplified the pain from the operational mistakes in their core offering.
A cautionary tale there. Okay, finally, let's look at the global brand segment. That's Theory, PLST, Comptoir de Cotonnier. Kind of mixed bag.
A very mixed bag. Lots of moving parts here. Overall segment revenue actually declined by 5.3%.
Okay, revenue down, so profit must have tanked.
But here's the twist. Business profit for the segment improved. Quite a bit, actually. It went from basically nothing, zero point 0.1 billion yen last year, to 2.6 billion yen this year.
Wait, revenue down 5%. Profit up significantly. How does that work? Heavy cost cutting. Some accounting footnotes.
A bit of both. Driven by restructuring, you have to look at the individual brands. PLST was the star performer here, strong growth in both revenue and profit. They called out wide pants and sheer sweaters, specifically. Very trendy.
Okay, so PLST did well. What about Theory?
Theory went the other way. Declines in both revenue and profit, so real divergence within the segment.
And then there's Comptoir de Cotonnier. The report mentions restructuring and impairment losses. That sounds bad. What does that mean for you listening?
Yeah, impairment loss is accounting speak, but it's important. Basically, when a company restructures a brand or closes stores, it might decide some assets like the brand name itself or store leases or leftover inventory aren't worth as much as they're listed for on the books.
So they have to write down the value.
Exactly. They take a charge, an impairment loss. It's usually a non-cash charge, meaning no actual money leaves the bank, but it hits the reported profit. Comptoir de Cotonnier had 3.9 billion yen in these impairment losses because of ongoing structural reforms.
So that made the segment's overall operating loss look bigger?
Correct. On paper, the segment had an operating loss of 0.9 billion yen because of that big impairment. But the report also says Comptoir de Cotonnier's operational business loss, just looking at day-to-day trading, was actually cut in half.
Okay.
Better growth margins and tighter cost control. So they're shrinking that brand, taking the accounting hit now, but making the remaining core business run better.
Okay, that clarifies things. So looking forward, despite some of these internal challenges, they just posted a record year. They must be pretty optimistic about FY 2026.
Very bullish. The forecast is for another record performance. They're projecting consolidated revenue to hit 3.75 trillion yen.
That's another 10.3% growth.
Yep. And they expect business profit to grow slightly faster again, up 10.7% to 10.0 billion yen. Clearly counting on that international momentum, especially UNIQLO International, to keep firing.
And what about for investors? Any direct benefit signaled?
Yes, they're forecasting another dividend increase, up 20 yen to 520 yen per share for the year.
And expansion plans still focus on those international stores.
Absolutely. That network proved crucial this year. They plan to reach 3,594 stores globally by the end of August 2026. And importantly, 1,765 of those will be UNIQLO International stores. That's clearly where the investment focus is.
Makes sense. One last area, sustainability. Their LifeWare philosophy kind of demands they take this seriously, right? Is it just talk, or are there concrete actions?
It seems pretty concrete. They talk about 6 priority areas, like human rights, environment, creating new value. But the tangible stuff is more interesting.
Like what?
Like the expansion of their UNIQLO studio. These are in-store services for repair, remake, even upcycling clothes to give them a longer life.
Moving beyond just selling new things.
Exactly. It's a service model, adds value. They had these studios in 63 stores across 22 countries by the end of FY 2025. That's a real investment.
And on the environmental footprint side, emissions and all that.
They seem serious there, too. They highlighted being on the CDP A list for climate change for 3 years running. That's a respected benchmark.
And they have specific targets.
Yes, pretty aggressive ones. A 90% cut in emissions from their own stores and offices by fiscal 2030 compared to 2019. And maybe even harder, a 20% cut in emissions from their supply chain by that same deadline, integrating environmental goals into the actual business plan.
Okay, so bringing this all together, if you had to boil down this entire record-breaking year with all its complexities into maybe 2 key takeaways for anyone watching the retail space.
I think 2 things really stand out. First, the power of geographical diversification, but also the brand equity needed to make it work. That massive growth in North America and Europe, fueled by brand heat, literally saved the company's record from the downturn in Greater China. The West rescuing the East, essentially. That's a huge strategic lesson.
Diversification and brand power. What's the second lesson?
Operational agility, or maybe the lack thereof. UNIQLO Japan showed agility by tweaking core products successfully. But GU's sharp profit collapse is a stark warning. It shows the immense risk you run if your model depends on chasing fast fashion trends, but your operations can't consistently deliver the right product at the right time. Missing the trend wasn't just a sales dip, it cratered their profitability.
That failure at GU really does stick out, doesn't it? Which leads us to the final thought for you, our listener, to chew on.
Yeah.
If a giant like fast retailing can see profits plummet by over 12% in a key segment like GU because they couldn't nail the hit products quickly enough, how much danger is any global clothing brand in if they aren't laser focused on predicting trends in real time and having a supply chain flexible enough to react almost instantly? Is the game shifting even further away from just making good clothes towards simply being the fastest? Something to think about as we watch where fast retailing places its bets next year.